This webinar is hosted by NowcastIQ. NowcastIQ is Andreas and mine institutional offering of our macro and geopolitical research. What we wanted to build with NowcastIQ was a platform that both contained our view of the world, but also contained our data models that we are very, very proud of. So Andreas and I spent a few years building these proprietary data models that are focused on gauging the current macro regime and delivering trade sentiment and trade ideas beyond out of that. So the Nowcast IQ models are proprietary. They are using publicly available data, but in a very, very unique way that gives you a time edge on the typical data prints on inflation growth and the measures on liquidity. And instead of giving you a deep dive, we did that on our prior webinar, and we are very, very happy to do so in one-to-one calls. So instead of doing a deep dive into what goes into these drivers, I wanted to take a more actionable approach and look at what the models are telling us right now and how it is affecting you, Andreas, as both as a researcher, as a content creator within the space, but also as an investor. So maybe, Andreas, while I click around the Nowcast screen, tell us, what do you use out of these data models, and what are you using and looking at currently?
Over the past 6 to 8 weeks since we hosted the last webinar, we've obviously seen a major development in the world of macro due to the closure of the Strait of Hormuz. So what we're currently seeing is a clear move towards a more inflationary world, a macro environment that has moved from a benign inflation environment to one that is more hostile. But the interesting thing is that we're yet to see any major impacts on the growth momentum in the US, for example. So the US growth momentum has held up incredibly well amidst this inflation spike due to the war in Iran. So overall, what we've seen basically over the past 6 to 8 weeks is a move from a world where the growth accelerated alongside fairly benign price developments to a world where growth is still accelerating while prices are going up at the same time. Liquidity has been fairly benign throughout this whole period of war. But I think the major and most underappreciated trend in our macro models right now is that growth is actually doing very well from a rate of change perspective, especially in the US, but also a few other places around the globe, which we'll dive into in a second. So overall, what do I use this for as a decision maker when I make investments as a portfolio manager? Well, the interesting thing is to always live gauge what's going on in the real economy versus what is the consensus among other decision makers. And that is also why we always look at these macro trends from a probability weighted perspective, since that is basically the key if you are to make investment decisions on the back of live data from the macro economy. Is growth accelerating, and how certain are we that growth is accelerating? And currently, we are fairly certain that inflation is accelerating, that liquidity is accelerating, and that growth is accelerating in the US, leaving us with a so-called up, up, up environment. And in sharp contrast to what most pundits laid forward or laid out during April, this is actually pretty bullish for risk assets. We've seen a major rally, especially in tech stocks in the US, but equity markets have done way better than feared by many. And the nowcasting setup allowed me to stay fully invested and even add to these risk asset trends while most other market participants feared them the most. So that's essentially my top-down summary of how I use this platform and how I've used it over the past 6 to 8 weeks to make great returns.
Absolutely. Well, I just forget to mention, Andreas, when we got started, that we obviously welcome questions in this webinar. So there's a Q&A function in here in Zoom. So please do post your questions and we will get around to them, as many as we can get to. And if we don't have time for all of them today. We will reach out to you afterwards. So maybe Andreas, let's dive in here because I love to look at this historical drivers trends that you can set to a certain date range. If you use the 90 days, that covers a bit more than the 6 to 8 weeks you talked about, and this is the U.S. regime. We'll get back to
Yeah.
some of the other geographics lately. Um, let me just get sorry, I'm just clicking around here. Let me get the 90-day here. Here we go. So obviously the spike in inflation happening around the onset of the Iran war, still very at a very high level, naturally due to the oil prices. But what has held up growth? Because when we look at job numbers, one typical gauge of growth, they're not doing very well in the U.S. So if you look a little bit underneath the hood, what is keeping up growth in this model?
In short, we're starting to see an on-ground domestic capex cycle. So the simple way of understanding this is that you see, tremendous amounts of capex from especially the big hyperscalers, but we're also starting to see that spreading across the domestic landscape in the US, namely in everything related to the infrastructure build out surrounding this whole hyperscaler capex move. And therefore, we're probably at the stage of the cycle where this capex from the big hyperscalers is starting to slowly but surely filter through the economy, and we're seeing that in everything from infrastructure data to data from trucking, etc. Right, so things are moving from A to B or A to C in the US, and we can simply track that on a daily basis since we use these live gauges of the economy, everything related to shipping, trucking, contagion, etc. Right, we're measuring that live, and we're still accelerating. Remember, when you look at a distribution of outcomes as we do here, everything that's above 50% means that we have a base case of an acceleration versus the latest known value of growth, right?
Mm.
So in this instance, we basically measure the US economy based on the composite PMI, the Purchasing Manager Index, and it gives you a more than 50% probability of the PMI still increasing in value
Mm.
versus the latest known figure from April. So all in all, what started as a very semiconductor capex driven cycle, basically towards the end of last year and into the early innings of this year, is now starting to widen across the economy, and we can see that in the data.
So, Andreas, when you view these data from the U.S. and this macro regime of up, as we're calling it, the clearly the dominant regime here, how are you trading it? We have these trade sentiments over here that point at certain sectors. I'll just go through some of them. It's obviously based on the regime that we now see as the dominant one. Very bullish for gold and natural gas, obviously also being driven by the events in Iran. If we look at equities, at sectors of equities, very bullish for consumer staples, a very strong signal
Yeah.
there. Healthcare. Is this also what we're seeing in markets, or how well does this translate to these sectors?
To some extent, right? So we moved from this very benign inflation environment to an environment where everything is on the up at the same time. And interestingly, it kind of highlights now, and we use the empirical evidence of former periods with
Mm.
reminiscent macro trends to gauge the probability of various assets doing this or that in this kind of environment. And the interesting thing here is that it currently tells you that the consumer is in better health than what is being appreciated by markets. And that is probably the key takeaway from a market standpoint from this webinar this month, that the consumer level is doing better than feared. And that translates into consumer staples, but also consumer discretionary actually flags as a decent trade. And overall, the risk asset signal is clearly a green flag amidst this, which is again in sharp contrast to what you basically see everywhere right now, with everyone telling you to take profits after this 6 to 8 week run. Nothing in our data suggests that we're going to see a drawdown on the back of the macro conditions that we're able to measure. And again, highlighted by, for example, consumer discretionary or consumer staples, both actually work in tandem in this kind of environment. The US consumer is probably doing better than feared.
This asset analysis screen I just wanted to touch upon a little bit, Andreas, is a newcomer to the site. We've been using it for a while, and it essentially visualizes the past instances of the current macro regime up, and then calculates the average return essentially. So it's sort of a pattern recognition program. Obviously, you still need to use your head here. You still need to use your logical thinking. If you look at oil in this scenario, looking very, very good, but you should obviously factor in that a lot of special things are going on in oil at the moment. So that is the way I like to use it. I like to see, oh, there's a big chance in oil. Is there something else going on right now in oil? Probably. And obviously our models in quotation marks don't know that. They don't know there's an Iran war going on, if you know what I mean. They're just calculating objectively. So that is the asset analysis that I really, really like. You can pull it on geographies as well, and indices, and FX fixed income as well. A lot of options in there. So I just wanted to shift a little bit, Andreas, and this is something we're also looking to incorporate on the site. It's data that's already there. We're running these 5 geographies, the US, India, UK, Eurozone, China, and obviously the world. So the data I'm going to show you is already on the site. We're just trying to compile it in a slightly different way, or you've been compiling it, if I'm being completely honest, Andreas. Yeah. These comparisons, and I'm just going to make it a little bit bigger for you to see, where we take all the geographies and look at the rising growth probability. What really struck me here, Andreas, is India going through the roof with a very, very high probability of rising growth. Do you have any idea why? And is this a signal strong enough to actually trade upon it?
I certainly think it is. So a couple of things to note surrounding the Indian growth momentum here. What happened during the onset of this Iran war was that we saw a very uniform setback in the actual growth on ground in both India, the UK, the Eurozone, and China at the same time. India less so than the others. Why is that? Well, the 4 countries are all on the receiving end of the supply shock in energy, basically. They're all net importers, while the US is a net exporter, and therefore basically weathered the storm much better to begin with. Why is India suddenly accelerating 6-8 weeks after the onset of this war? Well, a couple of things to note in that regards. First, during this process, the secondary reciprocal tariffs on India were annulled by the US Treasury. So basically, India was punished earlier on this year for buying Russian oil. They're now allowed to, at least temporarily. So, and they've scrapped the very, very punitive tariffs put directly on only Indian goods and services, right? So despite being on the receiving end of this energy supply shock, India has actually received quite a few been a set of benign news over the past weeks, especially given that they're now able to buy Russian oil again, especially given that they've managed to sneak out some oil from Iran as well, directly from Iran to India through the coastal line. And on top of that, they've also managed to secure some flow from Venezuela, which they weren't able to secure ahead of everything that happened in Venezuela in January and subsequently also the Iran war. So when you look at what's going on beneath the hood here in India, you can see, for example, the cargoes out of Indian ports rebounding substantially. And it is most likely related to the scrapping of these very punitive secondary reciprocal tariffs on India. So we're seeing a rebound in India that is far exceeding what we see elsewhere. But it's also interesting, in my opinion, that we're starting to see stabilization in the UK, in the Eurozone, and in China from otherwise very weak rate of change levels back in April. And why is that? Well, the oil market, for what I am able to gather, is decently balanced right now, as China is essentially on some sort of a bias strike. They're not importing the same amount of oil as they did pre-Iran, and they're basically using their local storages to fill the void. At the same time, the U.S. is exporting more than ever, and fillings out of U.S. hoppers are extraordinarily high. So in total, the added US exports and the decreased Chinese imports have basically balanced the oil market by roughly 8 million barrels a day, maybe slightly less, which is the exact void you needed to fill when the Strait of Hormuz was closed, because we have managed to reroute quite a few of them of the barrels from the region anyway via pipelines, etc. So at least for now, this steady state where there's still a closure in the Strait of Hormuz is something that we can deal with. It seems like the U.S. and Chinese relationship is at least not deteriorating anymore after the meeting in Beijing last week. I'll allow you to unpack that in a second.
Mm.
But for now, that trade truce between the U.S. and China allows for a roughly balanced oil market despite a closure of the Strait of Hormuz, which has translated into a stabilization of the growth patterns in some of the countries on the receiving end of this supply shock. So I think all in all, the message today is that at least now, for now, we're holding up much better than most people feared.
Yeah, and I think talking about the U.S.-China summit and the relations there, you kind of have to compare to what was the situation 12 months ago. It's much better now. I mean, we still have a lot of issues in rare earths and semis and Taiwan, all sorts of things, but things are improving. We're absolutely in a detente between the U.S. and China. The sides are talking, they're visiting each other, they're not throwing tariffs at each other anymore. So we're absolutely in a more benign situation when it comes to the U.S.-China relationship. They're not going to be trading more with each other. That's going to be a constant, that we're going to have an ongoing decoupling between the U.S. and China. But at least the two sides are talking now. The big question for me, Andreas, is how sticky is this inflation that we're seeing, and what's the regional spread? And we had a question on that. Is the U.S. better set up to cope with this inflation than the Eurozone? And so I'm gonna point to this chart on inflation. Here we go. And before I let you answer, Andreas, just to note that we have all of you attending this show, we have set up free trials on NowcastIQ.com, so you can go in there and play around with the data and the asset analysis for yourselves. And then we will be reaching out to you. And if you don't hear from us, please do reach out for setting up permanent access. But you should all have free trial to play around with the data. That is always the best way to learn about a platform. But back to the inflation, Andreas, we are seeing a very high likelihood of rising inflation across the spectrum, except China. We can get back to that. It's probably not surprising, but do you see the U.S. as better coped to deal with this, and how sticky do you feel this inflation will be?
So to begin with, if we look beneath the hood of the current inflation pressure, it's still very isolated to energy, food, and other byproducts of the closure of the Strait of Hormuz.
Mm.
If you look at the most recent inflation report from the US, it basically trended exactly sideways if you set aside those impacts. So it looks dire when you look at this heat map of inflation trends across most of the West, but it is very isolated to a few categories. If you look beneath the hood, specifically in the US, we see very benign price trends in everything related to the healthcare sector. Also been a clear topic of relevance to the Trump administration. They've basically been pushing that agenda for a while. We see fairly benign trends in everything related to cars and other such larger durable goods. And that is, again, in sharp contrast to what many expected when tariffs were thrown around right, left, and center last year. So, sure, there is a nasty inflation trend, but for now, still very isolated to a few categories. Having said that, the longer the closure of Strait of Hormuz drags on, the more likely it is that we will see second order effects into other parts of the inflation basket. And when you look at, we've compiled what I call a necessity basket in beneath the hood of our inflation data here. And we've seen an increase of roughly 25% in that necessity basket. So the input costs going into manufacturing necessities or creating necessities, everything related to energy, chemicals, food, etc. That is maybe 1/4 or 1/5 of what we saw during the peak of the 2022 inflation crisis. We had more than a doubling of this necessity price basket back in 2022 against the backdrop of an increase of 25% now. So I'm still of the view that this inflation crisis is way more contained than what was the case in 2022. But I can obviously not promise that the Strait of Hormuz will open during the second half of the year. And if it doesn't reopen, we'll obviously probably stay in an inflation up environment. But there's still light at the end of the tunnel if you're hoping for better inflation numbers than what we're seeing right now. If you look at the sort of the retail layer or the consumer layer, we've basically seen flatlining consumer prices for most of May. So the reason why we see an increase versus April is the very last part of April and the first couple of days of May. So once we get the data out for May, and if we don't see further developments from the Strait of Hormuz, my best guess is that we'll see a sharp rollover of the inflation trends on Nowcast. But I'm starting to forecast Nowcasts. The whole purpose of the Nowcasting platform is not to have an embedded bias of what's going to happen. Because this data, currently the 21st of May, is telling you what to expect from the report that will be released mid-June. And that's the whole purpose of the platform, to ex ante give you a strong case for data that is released later, so you can act on them ahead of the crowd.
Absolute interest. Two very interesting questions here from Joaquim. I'm just going to do them one at a time here. So, if this model points to a risk-on regime of up, how should investors balance that signal against current market structure risk? Especially, he's talking about high equity index concentration in AI mega caps. And also the possibility that this current risk appetite is being driven by a very narrow part of the market. So how do you view that, Andreas? While you answer, I'm just going to open up our portfolio page, which is our current positioning that also speaks into this.
Yeah. So to begin with, I agree that it's been a very narrow rally. If you didn't participate in the pockets of the market that did well, you didn't really feel this rally. This morning, we got the numbers from South Korea on exports through the month of May. We got data from the first 20 days of the month. And the exports of semiconductors are up 203% year over year. I cannot underscore how crazy a number that is. It is also much crazier than it was just a month ago, and even crazier if you compare it to a quarter ago. So, currently live, and we have data up until yesterday, the demand cycle was still accelerating for these pockets that have, led the rally. We got the Bank of America survey out earlier this week, highlighting that the semiconductor trade is the most crowded trade based on all of the survey respondents. I think it's a lot more contrarian to say that semiconductors are cheap than to say that they're expensive. And nothing in the data that we track on a daily basis points to the demand cycle deaccelerating, rather the contrary. So I'm not overly worried about this concentration since it's based on actual demands. Of course, and we'll be the first to admit to that, once this demand cycle rolls over, you're going to see a landslide in these exact sectors because a lot of people are involved in that trade. But the good thing and the good news is that the nowcasting will help you in terms of guiding when that is. And I'll stress that again, there's nothing pointing to a rollover of the demand cycle as of now.
Another question from Joaquim here, very interesting. How does your liquidity framework capture the risk of a yen carry trade unwind? If Japanese rates rise or the yen strengthens sharply, would that appear first as a liquidity tightening signal, or a volatility shock, or more of a risk-off signal?
So specifically, the dollar yen is not included in the liquidity measure. Uh, I hold sympathy for the view that you need to account for the dollar exchange rate in your assessment of liquidity worldwide. And we do that in the liquidity measures outside of the US, but not in the US. So if you pull up the chart on the liquidity scores across the various geographies, Mikkel,
Yeah,
you'll also see that divergence right now.
absolutely.
Because if you look at, for example, Eurozone liquidity, printing just below 0.04, basically high likelihood of it dropping month on month. Same in China, same in the UK. While in the US, we see a very benign development in dollar liquidity. And the reason why we see this divergence is that the accessibility of dollar liquidity outside of the US has taken a hit through this Strait of Hormuz crisis. We've also seen how, for example, the UAE asked for a swap line to gain access to dollar liquidity through this. We've seen how Turkey basically had to sell their entire portfolio of US treasuries to get access to hard dollars, if you know what I mean, during this crisis. So we've seen that context basically more or less everywhere outside of the US through the last 6 to 8 weeks. And the US administration is aware of this and adding liquidity via the channels that they have available. So Joachim is right that if you see a material strengthening of the dollar, broadly speaking, it will be bad news for the overall liquidity environment outside of the US. Specifically referring to the dollar yen carry trade, we obviously saw major scare surrounding that in the late summer of 2024. And we've heard pundits talking about that risk ever since. I see very little surprise value in the yen carry scare this time around. Also positioning wise, if you look at various measures of levered positioning in this dollar yen carry trade, we're far from the levels that we saw in 2024. And therefore, it is not an immediate worry to me that the yen carry trade pulls the rug from under the liquidity cycle. But there is a point to be made that dollar liquidity is not as readily available outside of the US as it is in the US currently.
Very interesting, Andreas. So, allow me to wrap up a little bit here. We have been running Nowcast for a while now. We're very happy with what the platform is, but we're obviously developing on it, and we're very, very eager to hear your input on what could make this even more valuable for you. Remember that NowcastIQ is first and foremost a data platform, but you also get access to Andreas and my articles. So if you wanted much more of Andreas' analysis here, you can find it all on within NowcastIQ in our article sections. We publish, or as you say, you publish and just almost every day. There's something for your espresso, and we have a few weekly articles, so you get a lot of content in there. You also get access, as mentioned, to your macro portfolio, Andreas. It's contained of, I think we have right about 30 or 40 single name stocks that are divided into thematics, but obviously are weighted against the macro regime and the analysis that we do on Nowcast IQ as well. And finally, as mentioned, we have the asset analysis software, which allows you to deep dive into each asset that we or class or sector that we track on Nowcast IQ. So this was a little bit of a sneak peek into what this platform can do for you, and we hope that you find some use for it, that you will give it a go with your free trial access, and we look very much forward to talking with you individually along the way. So from me and Andreas, thanks to all of you for joining, and we're looking very much forward to seeing you on Nowcast in the future. Thanks for this time. We'll be in touch.